Good morning, everybody. Welcome to our weekly Monday webinar on the outlook for markets. I'm Joshua Tan, Head of Research, and I'll take you through the outlook for markets. And then Derek Heng, SG Equity Strategist, will give you update on stocks. And Brian Goh, our property analyst, will talk about one of our topics for the year, which is capital land. Our disclaimer. Okay, outlook has, there's no change to our outlook basically. We still think it's a positive climate for stocks in 2013, and it's the year to favor stocks over bonds. Okay, zooming in onto the blue lines on the slides. German confidence was improving. That was data that has come out over the past week. Industrial profit in China suggests the earnings turnaround is still on, and Singapore's industrial production picks up sequentially. So these data points further encourage us that our view is correct this year. Okay, no other change. Monetary policy remains loose. We still think there's too much money in bonds. We're overweight the same markets, China, Hong Kong, Singapore, on low expectations. Yet growth is better this year than last year's, and valuations have not normalized in these markets. Catalysts for the year would be China reforms, Spain activates the OMT, and earnings upgrades. Key uncertainties are the same: the sequester and the debt ceiling, and the Fed could get cool about QE, so we could have that withdrawn sometime this year, although we think the chances for that are slim. Okay, and we expect equities to build on gains this week, or if not, consolidate at their closer support levels. So let's continue. Okay, this slide here shows that we have been is basically summarizing our macro calls for the year. Last week we downgraded emerging market and Asian debt. So you see here overweight to underweight, and then overweight to market weight. Last week in mortgage-backed securities we downgraded as well. Okay, so we're progressively downgrading bond calls in favor of stocks, and as you can see, our overweight call in equities, we have a 7.3% total return for the year versus 3.8% total return for bonds for the year. So that seems correct as well. Going over last year's calls, we had 23 calls, of which 19 were right and 4 were wrong. The wrong ones, if it's of interest, is that mortgage-backed securities, we were too optimistic on it last year. The US, we were too pessimistic. Eurozone, we were too pessimistic. In India, we were too pessimistic. But we note that in our core markets from China, Hong Kong, Singapore, Malaysia, Thailand, Indonesia, Philippines, we got them basically correct, and we're quite timely with upgrading China stocks. Okay, let's move on. The S&P 500 has broken through its 1470 resistance, so we've been talking about this for a while. Last week actually we highlighted the breakthrough, and we noted that it would be it's a good sign, because that would mean the S&P will push higher, which it has. So if you look there, it's pushing higher. So we're still positive on the US, and although we are market weight in terms of relative returns, this is because of the obvious risks in terms of the sequester and debt ceiling. Okay, but excluding those, right, we are positive on the US. As you can see, there's not a lot of very strong resistance lines from now till the cycle high of last cycle's high in 2007. If you wish to trade the S&P 500 or the Dow, Phillip CFD has the following instruments over here. 2 instruments to trade them, and the ETF to trade to invest in the US market is SPX.AMEX. Okay, the STI, we'll overweight the STI, and we think it's now going to shoot for the 3,300 mark, which is the cycle high over here that was put in 2010. If not this week, then eventually in the course of the year. Support is at 3,200 should there be a correction. Phillip CFD also has the following CFDs to trade the Singapore indices over here, and the ETF is the SPDR STI, which is ES3.SGX. Okay, last week we were pretty positive on China making further gains. However, it was cut short due to North Korea's new threat of a nuclear test. Okay, so we have been saying that for the HSCI, it's broken through the very crucial 12,000 line, and it was moving higher from Monday, Tuesday, and Wednesday, and then Thursday, North Korea had its announcement, and then a lot of the gains were lost. Nonetheless, it's consolidating at the 12,000 mark, and we think over the course of the year it should grind through the 12,000, 14,000 resistance region to head higher. Clients who wish to invest in the H-share market can do so through 2828.hk. Okay, that is a physically backed ETF that proxies the HSCEI. Okay, in terms of the A-share market, we have China's economic data showed that industrial profit was continued to bottom out, and we think that this could encourage the indices to move higher. There's the resistance at 2700, and we're about 100 points away from that, and 2500 is the support. Okay, so I think we'll probably move towards the 2700, but there could be some profit taking in the meantime because the index has moved up quite a bit already. The Hang Seng, similarly, we expect it to grind through this resistance region of 23,000 to 25,000, or if not, consolidate at the 23,000 mark this week. Clients who wish to invest in Hang Seng can do it through the 2800.HK. Okay, let's move on to the KLCI. Now the KLCI, if you've been reading our morning note, we've been saying that it has to survive the 200-day moving average. And indeed it has done so. So I think we're set for a rebound higher. We're set for a rebound higher here. Oops. However, keep your stops tight, okay, because this is the second test of the 200 DMA in 3 months. Basically, the market is the KL market is getting jittery because of the upcoming elections, and BN, Barisan Nasional, is expected to put in a weak mandate. Okay, and basically a weak mandate means that a lot of the government transformation programs that BN wants to put through, which Malaysian growth is predicated upon, may not get passed through, or rather will be there's a possibility that they may be diluted. Okay, so which is why we're seeing there's the uptrend for the KLCI is being stalled right now. We have been market weight the KLCI because of this political risk, and we continue to do so. It's not a preferred market at the moment until we'll see after the elections and see what happens. Okay, for Thailand, we have the beautiful uptrend continues. Our equity strategists in Thailand forecast 14% year-on-year earnings per share growth. Clients who wish to invest in Thailand can do it through the BXT MSCI Thailand. There's the ETF on the SGX. Code is LG7. Okay, I'll move you on to Derek Heng, our equity strategist. Thanks.
Good morning. Thanks for joining us. This is, as we all know, this is the results. We are in the midst of a results season. We actually went through this slide some time back, which is a commentaries that we made on 17th of January. So far, things have been playing out according to what we have been expecting. The first one, we have highlighted that two stocks could report significantly higher profits. That's Tiger Airways and NOL. Tiger Airways have reported their results last week, and as expected, they actually reported their first profitable quarter after 6 consecutive quarters of losses. The market reacted positively with the stock trading higher, but we maintain our cautious view due to the hefty valuation on the stock. Minor correction here actually. The target price is revised down to 65 cents. NOL, we still maintain our positive view, targeting 136 with an accumulated rating. Strong year-on-year profit growth. Pan United is still expected to finish the year strongly, with sets announcing expected to report close to 30% growth in profits on margin expansion and higher sales on the aviation business unit. SGX has reported double-digit profit growth and the stock has been trading higher. Minor correction here again, its accumulated rating target price is higher at 788. Potential disappointment, StarHub and Genting. Alright, we'll move on to our view for the first quarter. Actually, we think that the cyclical stocks in the industrial space could do well in the near term. Both PMI data has been in expansion territory across major areas. In European side, it has been contracting less, but overall it's probably a positive picture. Here we have three stocks which are in the cyclical industrial space. First of which is SIA. Largely is a valuation call actually. The valuations are already at recession level valuations at close to 1 times FY13 book value per share. That is backed by cash per share of close to $3. According to latest surveys by IATA, insiders at the airlines are all turning more positive. You may want to refer to our morning market commentaries on the 22nd of January for a little bit more details. NOL, as I've mentioned, we have a positive view on the stock. 6 key reasons. First, unit costs is expected to decline. Sale of NOL building would ease leverage on the stock, on the business balance sheet. Thirdly, improving economic conditions in the US. Fourth, trade cycle seems to have bottomed out. Fifth, easing of ships on order, which is a key source of overhang in the shipping industry. And sixth, rational competition within the major players. The next one is Kappakappa. It has a positive surprise from higher dividend distribution, 27 cents per share in cash and 27 cents more in distribution of K-REIT. Overall, the outlook remains positive for the O&M business, with our analysts expecting close to $6 billion of order wins for 2013. Well, some research updates for the week. What we have been publishing for the previous week, we maintain our neutral view on M1. Even though the earnings were slightly lower than expected, the $5.50 increase in ARPU for the 4G customers were a positive sign. Capex guidance was slightly higher for 2013. SGX, as we have guided earlier in our commentaries, earnings were up 17%, and we have raised our FY13 earnings forecast, upgraded to accumulate with a higher target price of 788. GMS, it was elaborated separately by Joshua. Tiger Airways, mentioned earlier. CapitaLand, credible set of results in such a challenging year for the company. We lifted our RNAV higher to 530 and target price lifted to 424. Dividend per share was also above our expectations of 8 cents, coming in at 12 cents per share. Kappakappa, stable offshore and marine margin, with overall results in line with our expectations. Parkway Life REIT, that was published this morning, 7.4% increase in DPU for the year, and we expect positives to come from 3 areas. First, the asset enhancement for the Japan properties, CPI pact for the Singapore ones, and inorganic growth with its high debt headroom. We also updated on China and Hong Kong strategy and maintain an overweight rating on the area. With that, I'll hand over to Brian, who will talk about our stock pick for the week, CapitaLand.
Hi, good morning. Today I will talk about CapitaLand. We have featured this stock some time ago, but now just to recap on this company and also give you some updates on the company. Basically, we would like to draw your attention to the asset diversification of our CapitaLand. As of last year 3Q, their assets is 1/3 in Singapore, 1/3 in China, and about 17% in Australia. and that gives a pretty good diversification over the geographical regions. And in terms of China, as we are looking at China bottoming out, so the potential of CapitaLand to benefit from the bottoming out of China is through the various sector. It has 1/3 of its China assets in residential, and another 35% in retail, and 22% in the mixed developments, including the referral cities. So with that, we look at CapitaLand in China is not just concentrating on the residential sector, but it's pretty good to diversify into the various segments. So in terms of policy risk onto the residential market, that's limited. And some of the highlights, the company it's have good track record in originating the property funds and also REITs. And through the divestment, they monetize their assets and while maintaining their control in the assets, and they also collect management fee after the monetization. And they have a good pipeline of seed assets, especially the referral city portfolio in China, and these are the good assets that is under development that is potentially could be divest in future over the next 2 to 3 years. Another growth driver will be from the service residence sector, which the company has set target of 40,000 of apartment units to be achieved by 2015. 40,000 apartment under management by 2015. And in China alone, they are targeting to grow the apartment under management from 8,000 currently to 12,000 in 2015. And for recovery in China residential market, we have seen their sales of residential units and sales value both improve in the 3Q 2012. So for the 4Q, we expect them to do well as well. As we can see from CapitaLand, which have reported result last week, they have reported improvement in the 4Q. So we expect CapitaLand to do the same, have the same improvement as well. And the company also holding strong cash on hand, and they are still remain in investment mode even after invested for the past 2 years. 2011 they spent about 11 billion, and 2012 they spent about 3 billion in new investment. So currently they have strong development pipeline, and currently the CMA and the underlying REITs are performing well. So while the company earnings perform well and also share price perform well, we see the chances of these REITs to acquire assets from the parent company, it's getting higher. And other policy, other risks from the discounter, it's including the policy risk in China and Singapore, as the government in this country is implementing new policies to control and stabilize the rising residential price. And our current target value, target price of $3.97 already hit, and currently the company is trading above $4, slightly above $4. We see there's high chance of increasing our RNAV in this coming 4th quarter result reporting. So it's pretty likely that we will revise the RNAV upwards, and the same for the target price. There's still upward revision potential. And in terms of valuation, currently it's about 1.1 price to book, which is still very conservative. In the last property upcycle, where the property counter, this property counter actually traded to about 1.5 times book. So currently 1.1 times book is still pretty conservative. and we think there's still upside to this counter. Some updates on the company recent developments. They went through a management restructuring. They have a new president and group CEO of Mr. Lim Ming Yen. So he has lead the company into this restructuring to focus into core market, which is Singapore and China. And they have CMA Escort and Escort, which operating pretty much independently. So this is a simplified corporate structure for CapitaLand, which compared to the previously where they have almost 9 different business units, which is very complex. So currently this is much more simplified, and according to the management, they can allocate the resources more efficiently and can react to the market swiftly and in terms of deployment of funds. And for the core market, previously they have Singapore, China, and Australia, but now they are focusing into Singapore and China, while the Australian is operating pretty much independent by its own. And the group mentioned that they will review the Australian investment, and if there's a good price, they will be exiting the investment in Australia. And the management also mentioned that the non-core assets in the other non-core markets such as Europe, India, and Vietnam, they will conduct review as well. And so from this restructuring, we expect for the next 12 months there will be some divestment of its non-core assets in this country. For the residential segment, the latest site they got is from government land sales, which is Bishan Central, which yield about 700 units. And this is next to their existing project Sky Habitat, which currently, as of December, sales progress is about 30% sold. And the rest, Interlace, is about 71% sold as of December, Deleden about 49%. And in terms of the new latest cooling measures implemented by the government, we think that as investor we should monitor the sales probably for the 2 projects, the Sky Habitat and the Bishan Central, because these 2 sites, the acquisition price is pretty high and selling price also pretty high, about 1,400 to 1,700. So if you ask which development is more vulnerable to the change in policy, I think these 2 sites, we have to keep a close watch on that. And other than that, the company also they recently they have cut price for their Deleden project, which we see pretty strong sales for the past 3 months, averaging about 30 over units per month from Deleden. So they have managed to inch up sales to 49% by December last year. So we have the sales transaction price here. As you can notice here, most of the sales, over the past 3 months, they have collected more sales over this period as they lower down their selling price, which is closer to 1,300 per square foot now. And we estimate their break-even price is around 1,300, so currently it's still manageable, not into losses yet. But we foresee that their margins will be under pressure following the latest cooling measures. Nonetheless, CapitaLand, their residential segment in Singapore is still less than 15% overall, so we expect the impact to be minimal. In terms of earnings, the 9 months 2012 reported revenue already formed about 73% of our estimates for the FY12, and in terms of profit ex reval, it's already the reported already formed about 76%. So we see pretty easy for them to hit our estimates currently. And in terms of the PATMI, compared to our adjusted PATMI, which exclude the reval gain, we see the PATMI this year is still lower than FY11. This is because we don't estimate the reval gain, so we expect the 4Q to report reval gain, which will make this section, this PATMI here, to be comparable to the last year. And in terms of adjustable PATMI, hello, in terms of adjustable PATMI, hello. Mic test. Hello. Hello, testing. Okay, we have a disruption in the audio connection. Okay, I shall continue now. For the adjusted PATMI, which is excluding value, we see that our forecast is pretty comparable to the last year one. Right. And next, this is a price chart for comparable of the three property developers in Singapore. Following the latest round of cooling measure implemented on January 11th, this chart shows the reaction of these three counters for the following Monday, the price reaction. As we can see here, CapitaLand fare much better compared to Keppel-Land and CDL in terms of price drop. And in terms of percentage drop, as we can see here, CapitaLand on Monday, on January 14, drops about 4%, and for Keppel-Land and CDL, which the decline is more than 7%. So that's why we want to emphasize our strategy of picking CapitaLand as a more diversified developers, and this is where it can be more resilient in terms of new policy risks implemented by the government, which diversified company like CapitaLand will be able to fare better in event like this. And that's all for our today presentation. If you have any questions, please send it through the webinar, and we will try our best to answer.
Josh's. Am I on?
Yeah.
Yep. Okay. Hi, Josh is back. Okay. Okay. The question here: can we get a copy of the presentation? If you're a remiser, you should have been emailed one. If you're a client, you have to ask your remiser to email you one. Or if you're a Poems client, then you should ask the Poems dealers there to to email you a copy. Okay, now, what's your take on the STI? Will the run extend beyond China? Well, yeah. I mean, we're overweight Singapore this year, again, as we were last year. And yeah, we're pretty positive on the STI. Valuations are still on the low side. Growth this year is going to be better than last year. So there will be nominal earnings growth. And yeah, we think it'll outperform again this year. And like we said, we're very close to the 3,300 mark. And I think we're going to shoot for it. And of course, the backdrop of an improving China is very good for Singapore. And the other thing is we're also overweight China. So if you wanna invest or trade this outlook, you should download our GMAS reports, and then there you have the ETF tickers to do so. Okay, for the H share market it's 2828.Hong Kong. For the A share market it's 83188.Hong Kong. And for the Hang Seng it's 2800.Hong Kong. Okay, which is going to have a better return, CMA or CapitaLand? I'll pass you on to Brian.
Hi, okay, this is Brian here. We have a question on which is better return for CMA or CapitaLand. CMA has been a very strong price gain over the past year, and we think that it's going to be resilient given that the retail consumption is going to drive the China growth. But currently, as our valuation indicated, in terms of RNAV, we think there's better room for CapitaLand to grow instead of CMA. That's why we are currently selling, pick CapitaLand over CMA. And that's our view for these two counter. Thank you. I'll pass on to Kent. I'll pass on to Nicholas.
Testing. Hi, this is Nicholas. With regards to your question on Capo, well, it is we are very positive on O&M sector. With regards to Capo, it's we are still rating Capo as accumulate, given the fact that it has a potential gain of more than 10%, including dividend yield. With regards to Semcap and Ezion, we are not covering these two companies at this moment. We have no comments on these two counters currently. For earnings projection, for Kappakappa, you may want to refer to our report last week. We actually channeled a report with regards to Kappakappa after the result briefing. So yeah.
Hi, can you hear me? Okay. We have a question again on biosensors. I think we talked about that last week. So let me just reiterate the reasons why you should be considering buying this stock. We issued a report on 14th of January. You might want to refer to that. That will be a better guide in more detail. Let me just run through the reasons why you should be taking a look at the biosensors again. Investment merits following the acquisition of JWMS. one of the top 3 DES player in China. We believe that biosensors is well positioned to benefit from the growing DES market. DES stands for drug eluting stent. The successful launch of biometrics, which is a key product for the company in 2008, led to strong growth in the earnings over the past few years. Going forward, we think that earnings upside will come from growth in new markets where the company achieve regulatory approval for the use of its products in other jurisdictions. For this company, you also want to take a look at licensing revenue, which contributes significant income stream for biosensors. They currently have a licensing agreement with Terumo, which actually is derived from the sale of Noburi, one of the DES product that uses the biometrics technology. With a strong balance sheet, we also expect biosensors to continue its growth trajectory by acquiring companies with complementary technology. You might have heard that the company actually announced some fundraising from the debt markets recently. With that, they have a very strong cash balance that could fund any acquisition of the stock of complementary businesses. However, we like to highlight that we do not have a rating on the stock, as we do not cover the medical sector. I'll hand over to Joshua.
Hi, we have a question on okay. Well, the question here is that there's a growing disconnect in the sense that the World Bank has downgraded its global GDP forecast, yet I think we're positive on equities, and I think a growing number of houses are also positive on equities. Okay, this is a good question, but no disrespect to the World Bank and the IMF and all those, but they tend to be extremely optimistic with their forecasts. So their downgrade of this year was because they were too optimistic with this year. Last year, okay, last year they were too optimistic on 2013, and therefore they had to downgrade their forecast. Okay, and you also have to remember that the IMF and World Bank have very different agendas on when they do their forecast, right? For us broking firms, we are really looking at changes in expectations also factored in. So we don't just use GDP as a metric to forecast a better equity market or a worse equity market. It also depends on expectations, on earnings, on valuations. Okay, so these are the other things that drive our belief of why equities will outperform this year. And one of the main reasons is that there's just too much money in bonds right now, and actual real returns for bonds is very miserly. Okay, and we think that because there is a rebound in many economies globally, then that equities will probably outperform this year. Okay, there's quite a few questions here on currency trading, and although we don't have formal views, but I think given the level of demand, we will seriously consider it, and we'll give you, and I'll have a discussion with my macro team and see if we can meet that demand. Okay, there's a question here on Chip Eng Sing. Okay. Yep.
Hi, this is Brian again. We have a question on Chip Eng Sing. There's been run up a lot in the price recently, and what's the reason for that? And according to what we study on the company, we actually noted that the current development projects, those residential projects, most of them they have been either fully sold or a high percentage has been sold. So in terms of earning qualities going forward for the next 2 to 3 years, it is pretty good, looking at the high percentage of the residential sales already secured. And in terms of contract order book, the company has currently building construction order book of about 640 million as of last quarter. So for that, in terms of contribution from the construction segment, is pretty stable in our view. and there's also room for growth because the government is driving. The so-called BTO sales, so there will be increased demand for construction company. And thirdly is about the company project at Alexandra, which you may have heard of, the project Alexandra Central. The project is a mixed development which they have hotel and also retail development at the lower floor level. So the company has launched the sales for retail strata title over the past week, and they have received very good response for that. And according to media report, it's like almost everything sold except 2 units, and they were sold at very good price, ranging from 4,000 to 7,000. So with that good response for the retail segment sales, we think that there's pretty much upside from that development itself, which because we don't have official coverage now, so we can't give you the figures or the target price, but we think that this company has a good fundamental which worth the investor taking a look. And next time I'll pass on to Joshua.
Hi, Joshua again. There's a question here on when do we think QE will end. Baseline, we think 2014 is when it will end. Yes, there is growing doubt on the marginal efficacy of QE because, earlier on, of course, it had a big effect, but as the years go by, the effect is less. Anyway, we actually don't think the end of QE will be that bad a prospect for markets because number one, it's actually going to be worse for bonds than it is for stocks. So as you know, most of the QE is for treasuries and mortgage-backed securities. It's propping up the price. So next year, if the economy is still on a growth trajectory, that's one reason to own fewer bonds, and the other reason, if QE ends, right, will be the main reason not to own bonds. Okay, and this will provoke an even bigger rush into equities, which that's what we think at the moment. Okay, so we actually don't think it's that bad. Traditionally, actually, when monetary policy starts to tighten, it's not always bad for equities. Okay, when it starts to tighten, it's usually worse for bonds, and it provokes a rush into equities. This is what we've observed with the Fed funds rate over the last 30, 50 years. Okay, at the beginning phases of tightening, actually, it's a signal to investors that the economy is actually strong enough for the Federal Reserve to tighten, and it provokes a rush into equities out of bonds. Well, you can't say that this will always happen, but it pretty much has happened for the past 30 years. Okay, if we have no more questions, I think we can end our session. Thank you very much for being here. Not every question we can answer. There's a question here on Noble, but we have no coverage on Noble at the moment. We'll try and address that as the year progresses, because we had a change in our commodities O&M analysts, so we have to reboot the coverage there. Thank you so much, and we'll see you again next week.